Awesome. All right, now we are on kind of one of my my little dirty little favorite stocks, Visa. Visa has just always been like, like the stock went public in '08, and then it just like kept going up and up and up and up. I mean, it's exactly what you want to see from a company. Now, obviously, this kind of growth is from all speculative knowledge of what I know. I mean, if you have a stock that just goes up forever and ever. And ever, like usually, like you can't really sustain that forever. Like it's not just gonna go straight up forever and ever and ever. And that's a shame because that would be pretty freaking nice if it did. But obviously at a certain point, like something has got to give. Usually when you have investments in stuff like Visa, that has just had such a ridiculously positive history. Really what you're looking for, there's a couple of really big things to learn from this, but really what you're looking for, the only thing that can really turn this crap around is some kind of recession. And that's like basically probably what's going to happen. But it's interesting because I want to point out something really critical about this position, because you see like this investment was like right about here, okay? So all of this had already happened. And I mean, I was like 10 when that happened, so like I'm not like that sure that. So like you start here, and what's interesting is Visa was at like what, $25, and then they doubled, and then they doubled again, and then they doubled again. And what's cool is they just keep doing the same thing over and over and over again. You can kind of jump on that bandwagon, like there's no reason not to. Now here's the interesting thing though, like you get in kind of like right here. And you're gonna make, a bunch of money, right? And that's totally cool. But what's even interesting is like, if you hold this position not just for like a couple of years, not just for half of like 5 years or so, but if you hold it for like 10 years, hold it for like 15 years, and if you really have like that overarching long-term investment, now all of a sudden, I mean, you're basically 10xing your portfolio, or at least this specific investment. And what's cool is, usually you get a 10x return. It's not that tough. Like with active management, you make a swing trade on an option, and say your strike price is here, stock price kind of right around here, and I don't know, maybe you have some kind of wedge. The stock hits the wedge and it bounces off. You buy out of the money and it blows up, and it's a little bit risky. I mean, you're risking a bunch of your capital if you're making kind of like higher level options trades like that. But I mean, in a reasonable time frame, it's not that like complicated to have sort of 10x returns with traditional financial instruments in shorter periods of time. But what's interesting is like most of the time, if you make that decision, if you make that choice, you're trying to actually have these investments. Like this takes like a little bit of effort. And what's interesting is most people like aren't 100% always focusing on those investments, right? So because of that, like you take time off, you go to the beach, you have a party, it doesn't matter, whatever you want to do. And so because of that, like it's always nice to have this, like if you've got like your short-term stuff right here, you get your active money management, and then you've got sort of your swing trades, and you've got your long-term investments. And like that's what this portfolio is for me, right? It's a long-term investment. And so with Visa stock here, what's kind of cool is you kind of get the same returns you would expect from like active management, where you're sort of 10xing your portfolio, or you have the potential to like literally take an investment and just slap a zero on the end of it, and over time put more and more and more of those zeros on the end of it. And like in reality, you're not really doing anything that difficult. I mean, all you have to do is sit down and think, okay, well, let's see. There's like 3 credit card companies that exist, and Visa is like huge. They're probably pretty, solid investment. Now I want you to notice that my portfolio does not, at least from what I can remember, I literally haven't touched this thing forever, because you just make some money for you. It doesn't include stuff like MasterCard, it doesn't include stuff like Discover Card. And I want to kind of show you why, because when I first got in this investment, those were obviously opportunities. So what I did is I go into Young Finance, and I add a comparison to Visa. Now the first thing I want to compare it to is MasterCard, MA, right? I'm going to add that one. Now the second thing I want to compare it to is Discover Card, or Discover Financial Services. And those are the big credit card names that I know. You can add like other banks, you can add Chase and stuff like that, but for me really these were kind of the bigger ones I was looking at, because they were only the ones that made sense. And what I found is that like over time, at least in the long term, like most of these other companies that have cards were not performing nearly as well as MasterCard and as Visa. And so what I did is I got rid of these companies that weren't MasterCard or Visa, that weren't like making money hand over fist, and I just started looking at MasterCard and Visa. And what happened was kind of interesting. See, like you zoom in, oh, I thought MA for moving average was MasterCard, whoops, oh well. You start to realize that these stocks are very, 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 very highly correlated. And when you have two stocks that like literally look the exact same, what happens is kind of interesting. You get in one, and you get into another one, and they would literally do the same thing. And so this kind of comes into a judgment play. This kind of comes into a sustainability play. Apparently, MasterCard has very, very slightly outperformed them in the long term, which is pretty cool. I did not expect that. Like when I started out, I was getting this investment, I realized like MasterCard, I was looking at these balance sheets, looking at these portfolios, and like, the thing with Visa is, from what I remember when I was doing research on the stock, like solid, fundamental, long-term research, like what actually happened with them was like Visa is way bigger than MasterCard. If you look at sort of the market caps, because there's really only two major players in the space, you got 460 billion on Visa, and you go over to MasterCard. MasterCard is what? It's, you know, only say 343 billion, okay? So it's maybe like what, 3/4 the size of Visa? And when you have two investments that have basically the exact same industry, the exact same upside, the exact same amount of money in them, I had it on my watch list, but I didn't buy it. And the reason that I didn't buy it was because it doesn't make sense if you have two investments that are symmetrical in terms of returns, and maybe like a little tiny bit different, but in general they're the same in returns of returns. But there's a different amount of what? There's a different amount of risk. The reason there's a different amount of risk is because MasterCard, frankly, is smaller in terms of market cap than Visa. When you have a larger company, in terms of financial services, like if you look at the books, if you look at the little fine print, like larger numbers in financial services in that sector almost exclusively always mean greater what? Greater efficiencies. And when you have greater efficiencies, what happens is economics of scale. I mean, it's not that difficult. Efficiencies, right? Efficiencies. When you have greater efficiencies with economics of scale, especially in financial services, it becomes way, 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 way easier to continue this compound growth without necessarily having to risk your current clients. And so when I made this investment, I was looking at Visa, I was looking at MasterCard. They're both like super good, great tech stuff. They do well in bull markets, especially the tech markets, and they've performed phenomenally. When I was looking at both of them, I decided, look, like it makes sense after I've looked at this comparison. What I see here is I see the exact same returns for both. And like I'm not gonna like actually read you these guys' annual reports, but I was looking through their annual reports and I was looking at their charts, I was looking at their fundamentals. If you look at some of just the core statistics, not even going that deep into these stocks, you can see MasterCard, for example, is the biggest, thing you compare to. Their PE, is around 30, right? And what's interesting is their book value is around, I don't know, $6, right? And they're paying out 16% of their profits. And they're paying out 16% of their profits. Just do me a favor and cut out the part where it has this bar, because I don't want it to have that. Whereas here at Visa, you can see the book value is $14, so way more. And the payout ratio is $19, or 90%, so way more. So like when you have a bigger company and they're paying out more of their profit and they got more profit to pay out from, have dividends and they're really, really crushing it, it's important to think like, okay, does it make sense to buy this stock, or does it make sense to buy both of the stocks, does it make sense to buy one of the stocks? At the end of the day, it usually makes sense to get in both of the investments because you don't really know which one is going to do better. But when I was looking at these books and I was looking at the accounting for both of these, what I realized was like MasterCard at the price of, call it $300, and Visa was at like, I don't know, $125. And the book value for Visa was $14. And the book value for MasterCard was only like, $10, give or take. And so you've got a market price that is twice as much, and the book value is like 40% less, if that math's right. And so it didn't inherently make sense to buy both of these stocks, because like, if you do, you're kind of taking on more risk unnecessarily in MasterCard because they just don't have as much inherent value. And a lot of people say like, oh, you gotta buy more stocks, buy more stocks, buy more stocks to have more diversification. But if they're literally the exact same industry and they're very closely correlated, then if you buy both, like you're basically taking on the risk of both. And if the risk of Visa is inherently less due to its foundational, fundamental factors that look better than MasterCard's, just the books do, then it just makes sense to just buy that stock and then kind of ignore the other one. Now there are situations where this won't be true. We're going to see an example here later on with AMC and Regal, and those are stocks were in the movie industry, and they were very, very close. They were like equal competitors, and so you bought both of them. It was different for MasterCard. MasterCard and Visa, like MasterCard just doesn't have a lot of the footing that Visa has in many markets, especially in expanding opportunities in crypto. Like it's all basically Visa, and so because of that, just because of some of the knowledge I had fundamentally of which of these companies was really out there in the marketplace doing things, for this investment, I put a bulk, pretty much all the money I was sort of allocating towards these credit card companies into Visa, and it worked out pretty freaking well. It's almost doubled, up 80% or so. And it's just been pretty dope. I don't know how long they can continue this growth because, like I said earlier, I mean, eventually, like, even if you're in a rocket ship, I mean, you're eventually going to run out of fuel, and you can keep going forever and ever if you're in zero gravity, but eventually you're going to hit like a planet or something. So just kind of a really important psychological thing to understand with this investment, which is done phenomenally well. And definitely something cool about like splitting up your diversity and especially like your risk tolerance with different companies and understanding, because these are like longer term investments, like what's actually going on with the company. Like if I try to time this with technical analysis, I know it's a little bit dark, but I mean you have to like think about like what are you going to trade on this stock, right? Like you can add indicators. I mean, you can add honestly whatever you want, but I mean there's just not that much to use here. I mean it just doesn't look very tradable. I mean you can add almost anything that you want. Really, what you're going to see is you know the same thing over and over. And over again, just like people are telling us that it's super overbought, super overbought, super overbought. And in reality, like that's cool, but if all it does is keep going up and up and up and up, like indicators don't really work on that. It just doesn't really work, especially if you have monthly candles. This is as far as I can zoom out, and all it does is go up. Like eventually you know that it's going to stop, and so that's why you want to set a stop loss, and you want to probably set a trailing stop loss, and I should probably actually set a trailing stop loss on this one. So I'm going to write that down so I actually do it, because it'd probably make me a lot of money. So it's the trailing stop loss. But I mean besides that, really all you're trying to do is just have it work out. And so the big key and the big foundation here is just sticking with it until you want to get out. I don't really know when I'm going to get out of this one, but I'll probably just set a trailing stop loss. Then the moment the market reverses, the moment the stock reverses, you know, you're out of it, and you get to capture all of these gains. And yeah, I mean, like, guys, this is exactly what you want to see. And I'll finish this off with one last thing that I think is really critical. Because, like, this is probably the foundation of investing. If you don't, like, if you get this concept, then you're going to be solid, okay? So, you're a new investor, you're getting into new stocks, and you see two investment opportunities. Now, I'm going to draw two charts here, and I want you to think of each of these charts as a stock. And what I'm going to ask you to do at the end of this exercise is I want you to pick which of these stocks you would invest in. Would you invest in stock A or stock B, okay? And so you just think about that as I'm drawing out what these stocks do, okay? So the first stock is a stock that starts out here, and it goes like this, okay? Now, I want you to think about this just in any kind of relative time frame. Just think about it in whatever time frame you want. It really isn't that big of a deal. Now, the second stock I want to show you is a stock that's going kind of like this, okay? Now, the question is which stock should you buy, okay? Which of these two companies, which of these two stocks would you buy? Now, some people might see this question. They might say, Now, spoiler alert, the answer is holy shit, you want to buy the stock that just keeps going up, because this is going to absolutely crush it. But a lot of people might think that they want to get into this one because, oh, it's going down, it must be cheap or something. And, like, that's not the strat, okay? That is not, like, if a stock keeps going down, like, it makes sense for it to keep going down. Unless you have some kind of technical reversal pattern or something, like it's probably going to keep going down. Similarly, if a stock keeps going up and up, it's probably going to continue going up. And so you want to invest in equities and assets that go up so that you can continue riding them up. Or you want to short things that go down so that they continue to go down. And I think probably one of the best examples of this concept, and I think what you should finish on today, let me get some of this crap off of the screen. Is just a recent investment that absolutely exploded. It was amazing, literally freaking crazy. And it was Tesla, right? So like, let me do this weekly chart probably a lot easier to read. There's no way it's gonna hold this price, but whatever, right? So for a while, I think this kind of shows the chart the best, right? Just it's less scattered. All the stock did was go up and 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 up. And then I had this really nice W setup right here. I mean, this is a phenomenal W setup. This was the entry point. As soon as it broke, you combine W setups with moving averages at the breakout point. Like, if this is the stock price right here, and it's W, and the breakout point is at a moving average, that is going to be an absolutely phenomenal investment. It is going to crush it because you're combining one of the strongest technical patterns with one of the strongest indicators. It's the same thing with head and shoulder setup. So you have a head and shoulder setup, and then you have like a moving average, like right at the breakout point right here. Like that will perform way better than just a head and shoulder setup all by itself. And the reason why is because you're combining like really powerful candlestick indicators with really powerful moving average indicators, which are like amazing. It's amazing. But anyway, basically all the stock did was go up and up and up and up and up and up and up. And then had this phenomenal setup right here, and it broke out. It did amazing. And then, you know, it went to $970, $1,000, and it quadrupled in the span of like 2 months. So please don't fall to the fallacy that stocks that only go up are going to crash and they're going to die, because the short interest on this stock right around here was, I think, almost 9%. 9%. That's a lot of people that lost their ass once the stock went up. Similarly, if I can go over to the actual statistics, I'll show you what it is right now. But you can kind of see the exact same thing. We have a lot of people that are shorting when, like, you probably shouldn't be. You can see right here, short percent of float is 13%. That is a lot of people that are losing their ass. And the reason why is because people have this counterintuitive schema that's totally incorrect, this false belief that if a stock only goes up and up and up and up, then it's going to go down. That is not true. You want to buy stocks that keep going up, because when you buy stocks that keep going up, guess what? They keep going up. Now, it's not a guarantee. It's not 100%. You're obviously going to want to set some stop losses somewhere and please be able to sell when this shit happens. But you don't always 100% constantly want to be going against the grain, because in reality, like, momentum continues, right? And if the price itself shows its own trend, it's usually going to maintain that trend. And that's kind of the big message, the big lesson from Vista, the stock that looks like it only goes up. And it's insane to see this thing. It's like a straight compound interest curve on the stock, but it just freaking works, right? And that's sort of the goal. And that's the thing with financial markets is, like, you can find things that just work. And once you understand it, like, you can find things that just work, and then you can just do things that work. Like, you don't have to actually overcomplicate your investments. You don't have to overcomplicate your analysis. You don't have to overcomplicate anything that you do. And you can just take the money that the market pays you while still managing your risk with quality stop losses. I mean, with this investment, you're setting a stop loss at like 250, and you're risking $50 to make, I don't know, 800. That's a little bit aggressive, and this is a little bit of an extreme example. But that's really kind of the power that you have at your fingertips when you understand these indicators, when you understand these markets. And this is obviously more of a swing trade example, but with Visa, sort of a longer term example, when you understand that, like, a company that makes like 2% a cut on every single transaction that they exist in, like, the internet, and their markets are growing geometrically and their profits are growing exponentially, like, that's probably a pretty solid company to invest in. I mean, like, all the money flows through Visa, so, like, they're gonna make a lot of money. It's not that tough, and so it's always good to kind of have some of those staples in your portfolio that you know are like pretty freaking solid foundational companies. You know, even if, you know, right now I'm really leaning out of it and selling a lot of my stuff just because of, you know, the coming recession and stuff. But it's important to, like, still kind of know, like, stuff that's gonna last and really crush it, especially when the markets are bearish, right? And so, or are bullish, not but bullish. So with that said, hope you get a ton of value out of this module. Go out there, apply it, absolutely crush it, and I will see you in the next module. Thanks. Bye.